I would say that the short positions that they have now, and bear in mind that, rising prices just makes the whole thing worse. I would not be surprised if we have one or two of these players getting into trouble. I mean, we're talking about very, very large negative positions on their balances. And if you're a director of a bank, or let's say running the treasury department of a bank, and you're looking at the commitments that you have in these markets, you sort of think, well, de-gear my balance sheet, that's probably where I got to go.
The number of U.S. borrowers at risk of defaulting again on commercial property loans has surged to its highest level in a decade, sparking concerns about a banking strategy known as extend and pretend that may be concealing significant systemic risks. Regulators are becoming more concerned about the surge in loan modifications and their potential impact on distorting loan markets. A recent paper from researchers at the New York Fed highlighted that lenders often appear to be offering concessions to property borrowers, mainly to delay recognizing losses. Banks extended and pretended their impaired commercial real estate mortgages in the post-pandemic period, the authors noted, cautioning that these generous modifications could result in credit misallocation and a buildup of financial fragility. This practice is contributing to a rise in double defaults, further amplifying worries about potential risks in the financial system. Alasdair Macleod, a leading precious metals analyst and head of research at Gold Money, recently shared beliefs that the U.S. banking industry might be signaling another impending collapse, which he says will wipe out hundreds of billions of dollars. Macleod is certain that this collapse will be beneficial to the precious metals space, as it would force banks to reduce their ridiculous amount of short positions, particularly in the over-leveraged silver market. In addition, Macleod says a widespread collapse in the banking sector will force the Federal Reserve to start printing, another event that will hasten the adoption of a global gold standard. During a recent interview with Liberty and Finance, Macleod discusses these issues in full, asserting that the impending banking system collapse, and not the BRICS alliance, will push the world towards a global gold standard. As we present clips from Alasdair Macleod's interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video.
I mean, the new BRICS currency is not going to happen. Forget it. I mean, it really is. I think we just dismiss all talk about it. If anything happens, it will be as a result of the collapse of our currencies, because our currencies are credit. As someone said before a congressional committee a long time ago, the dollar depends on the faith, if you like, that people have in it, the faith and the credit in the US government. When that collapses, then there may be a change. And I guess that the change will not be a new BRICS currency, but what it will be, I think, is for defensive reasons, China and Russia putting their currencies onto a gold standard. Now, whether they do it properly or not, we'll have to see at the time. I mean, it's very, very simple to do. That's the important thing. Now, in terms of any comparison between the European Union and BRICS, the big difference is that the European Union is a political union, whereas BRICS is in effect a trade union. It's a union based on, if you like, free trade between the members. That's the whole point of it. And principally, it's not just free trade, but also the recycling of investment to improve the infrastructure in these countries, allow for the extradition of commodities and all the rest of it. I mean, for example, the building of a railway from Mombasa on the East African coast all the way through to the Congo is all about shipping out, sort of things like cobalt and copper and all these wonderful things that are being discovered in Congo. And in return, of course, the Chinese, are importing capital in, so the currency thing doesn't really matter in a sense. What they're doing is they're importing capital into places like Kenya, Uganda, Belgium, the old Belgian Congo, the Congo, Central African Republic, and so on. The idea basically being that by improving communications, by opening up the country properly, investing in it, then everybody's going to benefit, including China. The only country with a problem in this, I guess, really, is Russia, because Russia is a huge net exporter of energy in particular and other commodities, does not have imports that match. So she is always having to import other currencies, which is the result, if you like, of her sales of energy in particular. So she's up to her neck in Indian rupees, for example. Now, that's not a very happy situation for Russia. And I think that's why Russia was actually quite keen to push the idea of a gold-backed BRICS trade settlement currency back in August last year, ahead of the Johannesburg summit. But that is now a dead duck. That's not going to happen. If, as I say, if anything happens, it will be as a result of the collapse of currencies in the West.
Macleod has always been skeptical about whether the BRICS alliance was driven enough to achieve the very grand dream of introducing a gold-backed currency and payment system to rival the US dollar and the Western-backed SWIFT payment system. In previous interviews, while other prominent personalities in the industry were celebrating the creation of the unit, the alliance's proposed 40% gold-backed currency, Macleod insisted that what the world actually needs is a full reversion to the gold standard. According to the renowned analyst, that will be easily achieved when this next collapse begins, as central banks will be forced to return to the gold standard when their fiat currencies inevitably become useless. Macleod is of the strong opinion that the collapse will begin in the global banking industry, which he says is already showing great signs of trouble. This means the end of the gold and silver market manipulation that has held prices down for over a decade. Let's get back to the interview.
Banks are dealers in credit, and their balance sheets are leveraged, if you like, on equity. And it's wonderful if you've got, let us say, a 2% margin when you take into account all the costs and all the rest of it between what you lend out and what your depositors get. 2% fine, gear it up 5 times, that's 10%, gear it up 10 times, that's 20%. I mean, they're trying to get something like 25% return on equity, or maybe even more through this leverage. You can see how they get to that point, if you like. As the economic conditions appear to improve, then they increase their leverage. The other thing that has happened this time round is that as the central banks have reduced interest rates to the zero bound, or indeed into negative rates, what it's done is it's compressed the bank's lending margins, the difference between their asset returns on assets, which are loans up to whoever, what they give their depositors, if anything. And that squeeze in the margins, their response has been to increase their leverage in order to protect the bottom line. There is a payback at that. When interest rates start rising, as indeed Silicon Valley Bank found out, the whole thing goes into reverse, and very quickly you go bust. And this is how this is going to be dealt with is going to be a very interesting question. I suspect that because a primary duty of the central bank is to protect the integrity of the commercial banking system, the expense of this will be shown in the currency. In effect, the rescue will involve the Fed buying government debt so that it increases its balance sheet, it increases banks' reserves and all the rest of it. Not only that, but there will have to be rescues, which basically involve the printing of money.
Can gold, but especially silver, wrestle free of the constant price suppression or shorting and enter new price discovery?
I think the answer is that you'll continue to get that sort of market behavior so long as we have derivative markets, whether it's futures on COMEX or forwards in London, because that gives huge leverage to people who want to play games with real money. The thing is that these people playing games, they don't actually understand that gold and silver are real money, by law. By everybody's common law, they are up to their necks, if you like, in short positions. They want to retrieve that. They make a lot of money trading it. I mean, don't get me wrong. It's a very, very profitable business. While you're losing, let us say, in terms of valuation on your net position at every quarter or every month, if that's the way you account for it, the profits from trading should pretty much cover it. But I would say that the short positions that they have now, and bear in mind that, rising prices just makes the whole thing worse. I would not be surprised if we have one or two of these players getting into trouble. I mean, we're talking about very, very large negative positions on their balances. And if you're a director of a bank, or let's say running the treasury department of a bank, and you're looking at the commitments that you have in these markets, you sort of think, well, de-gear my balance sheet, that's probably where I got to go. I don't think it's easy for the traders, if you like, in the swaps and then the bullion bank traders and all the rest of it. I think they've got themselves into a really difficult position.
There are indications that the global banking industry is facing various challenges that could signal trouble ahead. There is an increase in the number of borrowers, particularly in commercial real estate, who are at risk of defaulting on their loans for a second time. This has raised concerns about potential losses for banks and the broader implications for financial stability. The use of extend and pretend practices, where banks modify loans to delay recognizing losses, is becoming more prevalent. This can distort the true health of loan markets and may create hidden systemic risks. Regulators and researchers have warned that such practices could lead to misallocation of credit and heightened financial fragility. Central banks around the world have raised interest rates to combat inflation, which has put pressure on both borrowers and lenders. Higher rates make it harder for borrowers to meet their obligations and increase the cost of funding for banks. Additionally, concerns over slowing global economic growth, coupled with geopolitical tensions and supply chain disruptions, are affecting banks' loan portfolios and profitability. Commercial real estate, in particular, is struggling in many markets, increasing the risk of defaults. Please share your thoughts on Alasdair Macleod's predictions for the US dollar, gold, and the global economy in the comments section below. Also, ensure you smash the like button, subscribe to the channel, and turn on the notifications bell for more videos. Thanks for watching, and see you in the next one.